Right now, someone is staring at that silver number and telling themselves it's just volatility. They're going to scroll past it, move on, maybe check back in a week. And that single casual dismissal is going to cost them in ways they won't fully understand until it's too late to do anything about it. Because what just happened to silver isn't volatility, it isn't noise, it is a signal, one of the clearest signals this market has produced in years. And if you don't know how to read it, you are flying blind inside a system that is actively counting on you staying confused. So before you close this tab, I need 60 seconds. I'm going to show you something most financial commentators either don't understand or understand perfectly and won't say out loud. A four-stage pattern that has repeated across 3 different centuries, 3 different empires, 3 completely different monetary systems. I'm going to show you exactly where we sit inside that pattern right now, not in theory, on the numbers, in real time. By the time we're done, what looks like chaos in silver is going to look like a clock you can set your watch to. Let's start with what you're actually looking at. Silver around $83.79. If you felt something was off when you saw that number, trust that instinct. Because that price is not telling you what silver is worth. It is telling you what the system suddenly needed. Those are 2 very different things. A price that reflects value is earned slowly, through supply and demand, through patient accumulation. A price that reflects what a system needed is created fast, in the dark, with no announcement and no apology afterward. Here's the frame you need. Global debt has now surged past $348 trillion. Not a projection. Not a worst-case scenario. That is the reported figure, driven by government borrowing on a scale that has no modern precedent. In the United States alone, debt is pressing toward $39 trillion. The Congressional Budget Office is projecting a deficit of $1.9 trillion in fiscal year 2026. Not emergency spending, not wartime stimulus. Baseline, structural. The machine running at its everyday, ordinary, this is just how it operates pace. When your debts are that large, interest rates are no longer just a policy lever. They become an existential variable. Every single point higher is a compounding claim on the future, a claim the system increasingly cannot afford to honor, which means the system has a very specific, very powerful incentive to control what certain assets do and when they do it. Silver sits at the most dangerous intersection of all. It is simultaneously money and metal, a financial instrument and a physical object that cannot be manufactured by a central bank at 3 a.m. That dual nature makes it something the system both needs and fears. It is the asset that, when it moves freely, exposes things the system is working overtime to conceal. So when silver falls like this, hard, fast, with a gap-down signature that no patient seller would ever produce, the right question is not, why is silver down? The right question is, who needed silver down, and what problem did it solve for them specifically on the tape today? I'm going to answer that. But to get there, we have to go backward, way backward, because the answer isn't original. It's the same answer it has always been. And once you see it run across 3 completely different monetary systems, you'll never misread a silver move again. There's a pattern. 4 stages. It repeats not because history is poetic, but because human incentives are constant and accounting identities do not negotiate with politics. Stage 1 is the setup. Every system begins by establishing an anchor, something tangible, something credible, something that gives people a rational reason to trust the unit in their hands. Sometimes the anchor is a metal, sometimes it's a fixed exchange rate, sometimes it's the cultivated reputation of an independent institution. Whatever form it takes, the anchor is the foundation. It is the thing that makes everything else feel real. Stage 2 is the expansion, and the expansion looks like success. Credit grows, the economy hums, debts roll forward, balance sheets stretch, but underneath, promises are growing faster than the reality that can back them. The anchor becomes a constraint to root around. Temporary measures become permanent. The narrative becomes, we have the tools, we can manage this. And for a time, that is even true. Stage 3 is the crisis. It doesn't announce itself. It shows up on the tape first. Assets that were stable start moving in ways that feel structurally wrong, not because of news, because the promises have run so far beyond the reality that the system must close the gap quickly, quietly, and at someone else's expense. Markets don't sell what they want to sell. They sell what they can sell. Liquidity gets sacrificed first, and the tape becomes a forced confession. Stage 4 is the reset. The anchor shifts, the unit gets devalued, wealth redistributed through inflation, default, financial repression, or some combination. Hard assets don't go to the moon, they get remeasured, because the measuring stick broke and anything real has to find its price in a weaker unit. That repricing can look dramatic, but it isn't drama, it's arithmetic. 4 stages, repeating across centuries. Now let me prove it, 3 times over. Imagine you're a Roman citizen in the 2nd century. You carry a small silver coin called the denarius. It's heavy in your hand, and it's real. Roughly 90% silver at Rome's peak. Every soldier receives it as wages. Every merchant accepts it without question. Every tax is denominated in it. The coin is the anchor, and the anchor holds because the empire's power and the coin's silver content are both credible and visible at the same time. But empires are expensive. Legions don't march for free. Aqueducts don't build themselves. And the political patronage that keeps the whole apparatus intact has a price that shows up in every budget cycle, compounding. Here is the trap every empire falls into eventually. The celebration happens first. The conquest is celebrated, the triumph is celebrated, the glory is celebrated. And then, quietly, years or sometimes decades later, the bill arrives. The state needs more revenue than it can extract through honest taxation without triggering revolt. So it makes a choice. The oldest, quietest, and most cowardly choice in monetary history. It starts shaving the coin. Less silver, more base metal. Same face on the outside, same official value, same emperor staring at you from the front of it, but thinner reality inside. Under Marcus Aurelius, the denarius is about 75% silver. Under Septimius Severus, it drops to 50%. By the 3rd century, it has collapsed to 5%. 5%. The coin that was the anchor of an empire's credibility is now mostly tin with a silver veneer, and the entire Mediterranean economy is still being asked to pretend otherwise. The disturbing part is how long it actually works. Trust decays slower than silver content. People accept the coin because they always have. Social inertia is enormously powerful. But eventually prices start rising because the unit is weaker. Soldiers start demanding higher wages because they can feel the dilution in their hands. The state responds by minting more coins to cover the gap, which makes the unit weaker still. Confidence begins to fracture. People start hoarding real goods and avoiding the state's money whenever there's a credible alternative. Does any of this feel familiar yet? The setup was the silver denarius and Rome's credibility. The expansion was fiscal overreach financed through quiet debasement. The crisis was rising prices, economic distortion, and the gradual collapse of trust in the unit itself. And the reset was the dissolution of a monetary system that took most of the empire's functioning institutions down with it. Not in a single day. Gradually, and then suddenly. Which is always how structural collapses happen. Now jump forward 12 centuries, not to another empire, to a broken republic. Germany, 1921. The First World War has just ended, and the Treaty of Versailles has imposed reparations that are, by any honest arithmetic, mathematically impossible to pay without destroying the domestic economy in the process. Tax capacity is constrained. Industrial output is recovering but nowhere near adequate. The political situation is volcanic, coalition governments forming and collapsing, the streets full of competing ideologies, the public exhausted and looking for someone to blame. The state has obligations it must meet. Obligations denominated in a currency that people still barely trust, so it reaches for the only option left, not debasement this time because there's no silver left to shave, but the printing press. It begins to manufacture currency to bridge the gap between what it has promised and what the economy can actually deliver. At first, it is manageable. The mark weakens, but slowly. Prices rise, but not catastrophically. The public notices and grumbles, but doesn't panic. Not yet. Here is what makes Weimar so instructive. The feedback loop that activates once a currency begins to crack is not psychological. It is mechanical. The mark weakens. Imported necessities get more expensive. Necessities rise. Workers demand higher wages. Wages rise. Production costs rise. Prices rise. The government faces a larger nominal gap, so it prints more marks. Each rotation runs faster than the last. Not madness. Arithmetic expressing itself in the only language it has left. By late 1923, the exchange rate has reached 4.2 trillion marks to one United States dollar. A wheelbarrow full of currency buys a loaf of bread. People burn paper money for warmth because it is cheaper than buying wood. Lifetime savings that built across decades by ordinary people who did everything right are erased in months. Not because those people made bad decisions, because the measuring stick broke around them. And here's the thing nobody tells you about Weimar. If you could have watched the tape in real time, the early movements would have looked exactly like what you are watching in silver today. Violent, disjointed, gapping, moving in ways that made no sense if you only read the daily headline but made perfect, terrible sense if you understood the mechanism underneath. The reset came eventually. A new currency, a new government, a different anchor, but the price paid was the destruction of an entire generation's economic foundation. and the political destabilization that followed shaped the next 20 years of world history. When the measuring stick breaks, it is never purely a financial event. It becomes a social event. It always has. The setup was the post-war German state and its fragile remaining credibility. The expansion was fiscal promises that outran productive reality. The crisis was the spiral, a forced confession on the tape of what the reality had always been. And the reset was the currency dying and being rebuilt from nothing. Now we come to the third case, the one that matters most directly to you, not because it is the most dramatic, but because the system it created is the one you are living and investing inside right now. The year is 1944. World War II is nearly over. Delegates gather at Bretton Woods, New Hampshire, to build a new monetary order. The US dollar becomes the world's reserve currency. Every other currency is pegged to the dollar, and the dollar itself is convertible into gold at $35 per ounce, legally, formally, upon demand. Any foreign government can take its dollars and walk out with physical gold. The anchor is explicit, legally binding, backstopped by the largest gold reserves on the planet. It works because the math checks out, for a while. But then comes the expansion, Vietnam, the Great Society programs, military commitments spanning dozens of countries simultaneously. The United States begins running deficits to finance its ambitions. Dollars accumulate overseas as foreign governments build up reserves. And quietly, the number of dollar claims on American gold begins to exceed the actual gold in Fort Knox that could satisfy those claims. Not by a little, by a lot. For years, nobody says this out loud. The system functions as long as everyone believes it functions. But then, in the late 1960s, some foreign governments start doing the mathematics. France famously begins converting its dollar holdings to gold. The drain on reserves becomes visible. Confidence begins to move. And on August 15, 1971, Richard Nixon appears on national television and ends the promise. The gold window closes, unilaterally, without warning, without a transition plan. The foundational commitment of Bretton Woods, that your dollars were, upon demand, as good as gold, is simply terminated. The anchor is pulled. What follows across the 1970s is not a Weimar-style collapse, no wheelbarrow moment, but there is stagflation, rising prices and stagnation simultaneously, which textbook economics had declared impossible. The 1973 oil shock, the 1979 crisis forcing Volcker to raise rates to 20% to wring inflation out of the system, and a surge in hard assets that rewrites every prior assumption about gold and silver, not because those metals changed, because the measuring stick had changed. It got shorter. Everything measured in it got taller. The setup was Bretton Woods and the gold-backed dollar. The expansion was fiscal overreach and global dollar proliferation. The crisis was Nixon closing the gold window and the decade of forced repricing that followed. And the reset was the birth of the system you are navigating today, a world of managed fiat currencies, backed not by metal, but by the credibility of central banks and the performance of fiscal responsibility. That performance, that word matters, because what we have now is not discipline. It is theater with good costumes. So lay those 3 case studies over today, not loosely. Exactly. Like tracing paper, placed over the same blueprint, drawn 3 times in different centuries. The anchor today is not gold. The anchor is the credibility of sovereign debt, the assumption embedded in every financial model that a government bond is effectively a risk-free asset. For decades, this anchor was reinforced by falling interest rates, by globalization keeping goods cheap, by the theater of fiscal responsibility producing just enough credibility to keep the machine rolling. That belief was functional. In some narrow technical sense, it still is, but it is under a stress unlike anything the modern era has produced. Because anchors built on credibility have one catastrophic vulnerability. They require restraint, and restraint is precisely what democratic political systems are structurally incapable of sustaining over long periods. When deficit spending buys votes and consequences are deferred to future administrations, restraint loses every election it enters. Without a hard constraint, gold, a treaty, an institution with real enforcement teeth, the expansion always runs to the boundary of what people will tolerate, and people tolerate a surprising amount when the deterioration is slow enough to normalize. So, the expansion has been compounding for decades. Credit expansion as the default operating mode, fiscal expansion as the default response to every slowdown, rolling obligations forward rather than paying them down, because paying them down would require austerity no elected government can survive. $348 trillion in global debt, a projected United States deficit of $1.9 trillion, not emergency spending, but the baseline minimum the system requires just to maintain its current velocity. And here is the inflection that makes this moment different from every prior warning about debt. People have been warning about debt for 30 years, and the system kept running. So why now? Because of rates. For most of those 30 years, rates were declining, which meant the cost of carrying all that debt was declining too. You refinanced lower every few years and called it prudent management, but that era is finished. Rates moved higher and stayed higher, which means every time a government rolls over its maturing debt, it is issued at a cost that makes the problem larger rather than smaller. The machine that used to purr as it compounded is now grinding as it compounds. Same mechanism, opposite direction. That is the setup, that is the expansion, and that is exactly why what you are watching in silver is not random. When a system under that kind of structural pressure needs dollars, real dollars, immediately, it raises them the fastest way available. It liquidates what the market will absorb at speed, without triggering a worse headline. Silver futures are deep enough, leveraged enough, and liquid enough to absorb enormous flows at the speed of a mouse click. A funding valve, a way to raise collateral and buy hours without generating the headline that accelerates the very crisis it is trying to contain. And here is the piece almost nobody connects. The fact that silver can be used as a pressure valve is inseparable from why the long-term case for holding it grows stronger every time it happens. Because each time the system reaches for silver to solve a short-term liquidity problem, it reveals something. Paper claims are multiplying faster than physical reality can support. The system is more fragile after the event than before it. The next scramble will be larger, and the one after that larger still. The paper system and the physical market for silver are held together by trust, settlement conventions, and the assumption that most participants never demand delivery simultaneously. In normal conditions, that assumption holds, but every crisis tests the stitch. Every test leaves it slightly weaker. At some point, that stitch fails, and when it does, the repricing of physical silver against paper claims is not gradual. It is abrupt. The kind of move that people who were positioned for it describe as inevitable, and people who weren't describe as impossible. Here is the diagnostic when you watch the tape. A genuine funding event produces a specific signature. First, a vacuum where a floor should be. Price falling faster than any patient seller would create. Recovery attempts fail, because intelligent buyers wait for forced selling to exhaust itself. The signal most people miss. Prices diverge across markets. Futures and spot out of sync. Spreads widening in ways that feel wrong. Stress propagating through connected markets, showing you its seams, the fingerprint of a collateral chain under pressure. When that fingerprint appears, you are not watching a commodity story. You are watching a monetary story dressed in commodity language. After the storm clears, you watch the narrative form. Commentators call it risk-off sentiment. A strong dollar, profit-taking, rotation out of commodities, all technically defensible, all missing the actual content. Because the tape already told you the truth while the commentators were still assembling their talking points. Now I need to say something that people don't enjoy hearing. A debt structure like ours has only a small number of exits. Default outright. Politically catastrophic, almost never chosen. Inflate the unit so debts are repaid in money worth less. Quiet, gradual, survivable. Repress yields. Holding rates below the real inflation rate so the value of outstanding debt erodes over time. A slow tax on savings requiring no legislation, no announcement, or attempt genuine austerity severe enough to restore the anchor, theoretically possible, never achieved at the required scale by any modern democratic government. Modern governments, without exception, choose the path that looks least violent in the short term. Manage debasement, episodic intervention, the obligation kicked forward to clear the next election cycle. That is the documented behavior of every government facing this combination of debt load, political constraint, and refinancing pressure, and that behavior creates a predictable environment for silver, not a straight line upward, a battlefield. Episodes of engineered selling followed by repricing that reflects the underlying reality once the system releases its grip. Violent, disorienting, legible once you understand the mechanism. The drop to 83.79 is not a price, it is a stress waveform, the system communicating something true about itself in the only honest language it has left, what things actually cost when someone needs liquidity right now and cannot wait. Most of the people who get hurt in this pattern never misread silver. They never understood why it moves the way it does. So when the engineered drop arrives, they panic sell into the weakness. When the relief follows, they buy back near the top. They react at every wrong inflection point, mistaking the mechanism for noise and the noise for the mechanism. And the system benefits, intentionally or not, it makes no difference, from exactly that confusion being the most natural response in the world. The people who positioned correctly in the 1970s were not people who predicted every monthly print. They were people who understood the structural reality. who saw that the measuring stick had changed, that real assets had to reprice in a weaker unit, and that the volatility in between was noise around a signal already visible to anyone reading the mechanism rather than the headline. The mechanism today is not similar to those precedents. It is the same mechanism. The anchor, sovereign debt credibility and central bank control, is under stress from promises too large to honor. The expansion, $348 trillion in global obligations, chronic deficits, a refinancing cycle compounding the problem, has moved far beyond what any credible anchor can support. The crisis signature, violent repricing in liquid assets, basis divergence, air pockets on the tape, forced liquidations that look random until you understand the mechanics, is visible right now. And the reset, when it fully arrives, will not be announced at a scheduled press conference. It will be expressed through what assets do, quietly and then quickly, and then at a speed and scale that makes waiting for the announcement the most expensive possible strategy. That is the urgency here, and it is not hypothetical. A system that is structurally unstable never announces that instability through its official communications. It expresses it through micro-events that look disconnected unless you understand what connects them. Silver is the honest asset in this story. That is precisely why it is periodically targeted, sacrificed in funding events, dismissed by commentators who serve the narrative, quietly accumulated by institutions who have read the history. Because it is honest. It sits at the seam between the paper world and the physical world, and cannot be permanently held below the price that seam implies. Paper can outrun physical for months, sometimes years. But the physical world always reasserts, in Rome, in Weimar, in the decade following Bretton Woods, leaving those who understood the mechanism wealthy and those who trusted the narrative impoverished. Stop treating silver like a lottery ticket. Stop checking the price every morning with the anxiety of someone watching a slot machine. That is exactly the engagement posture the system benefits from. Reactive, short-term, easy to shake out at every precisely wrong moment. Treat it the way the mechanism demands, as a positioning instrument for the kind of transition that happens when a debt-heavy system can no longer manage the gap between what it promised and what it can deliver. Hold it with a time horizon that matches the mechanism, not the emotion of a single session. The sharpest drops are almost always funding events, not fundamental failures. The story is never about silver. It is about collateral chains, refinancing pressure, sovereign credit stress. Silver just happened to be the most liquid thing in the room when the door shut, because confusion is expensive. In this market, at this moment, more expensive than most people who experience it will ever calculate. The pattern is older than every financial institution alive today. Anchor established. Promises expand beyond it. Crisis reveals the gap. Reset happens through whatever mechanism the system can get away with. And in the space between crisis and reset, silver becomes the battlefield where paper claims fight physical reality, pushed down whenever the system needs breathing room, repriced higher whenever reality reasserts itself. We are not at the beginning of this cycle. The global debt figure, the deficit trajectory, the refinancing arithmetic, the behavior of liquid assets under stress, all of it describes a system deep in the third stage, pressing toward what comes next. But the boundary conditions are set. The accounting is inexorable. And the tape is already telling you things that official communications will not acknowledge for months. The drop to 83.79 is the symptom. The disease is a system straining against its own promises in ways that 3 centuries of history suggest can only resolve one way. Symptoms matter because of what they reveal about what is actually wrong, not what they say about themselves in isolation. The people who see the mechanism clearly and early don't just survive what comes next. They position for it, not panicking at the wrong moment. Reading the tape for what it actually says, and acting on it before the consensus has finished assembling its explanation for why the last move happened. You have now seen the mechanism. You have seen it destroy the denarius across 3 centuries of Roman fiscal pressure. You have seen it burn a generation's savings in Weimar in months. You have seen it force a decade of structural repricing after Nixon's most consequential 15 minutes of television. And you have seen it mapped onto the system you are navigating today. Now subscribe. This video was the diagnosis, the mechanism in its raw historical form. The next video is the blueprint, how the modern collateral chain was constructed, why paper claims on physical silver can overwhelm the physical market for extended periods and then suddenly cannot, and what specific signals appear on the tape before the next lurch becomes obvious. The signals that give you time, the only real edge in a market like this one. If you understand what 83.79 actually means on the tape, you are already ahead of most people following this market. Now you need to understand what the pattern does next, because it always advances. The machine never stops. And the only question worth asking is whether you are watching it from the outside or positioned inside it. Subscribe, and do not mistake the symptom for the disease.